Jenna, I think adjusting journal entries get a bad reputation because people memorize debit-credit patterns instead of understanding why they exist. Then exam day comes, one little detail changes, and suddenly everything falls apart.
Exactly. This module is really about one big idea: accrual accounting. The journal entries are just the mechanics. If you understand the logic behind accrual accounting, most adjusting entries become predictable instead of something you have to memorize.
So today I'm going to play the skeptic. Why can't companies just record cash when it comes in and cash when it goes out? That sounds so much easier.
Because financial statements aren't trying to answer when did cash move, they're trying to answer what actually happened during this reporting period. That's the matching principle. Revenues belong in the period they're earned, and expenses belong in the period that helped generate those revenues.
So cash is almost like a noisy witness. It tells you money moved, but it doesn't always tell you when economic activity happened.
That's a great way to think about it. Cash and performance often happen at different times. Adjusting journal entries exist to bridge that timing gap before the financial statements are prepared.
That's already giving me a better mental picture. It's almost like we're taking a rough draft of the books and asking, okay, what actually belongs in this year?
Exactly. And that's why the textbook says adjusting entries are recorded at the end of the fiscal year before the financial statements are prepared.
I noticed another rule that seemed almost too simple.
Which one?
Adjusting entries never involve cash.
That's one of the easiest points to overlook. Cash already moved or hasn't moved yet. The adjustment isn't about changing cash. It's about correcting timing. Every adjusting entry affects one income statement account and one balance sheet account.
That's actually a fantastic exam shortcut. If I see cash in an adjusting entry, alarm bells should start ringing.
Exactly.
All right, let's tackle the first major category.
Deferred revenues.
This one always sounds backwards.
Because people focus on the word revenue instead of the word deferred.
Walk me through it.
Imagine someone pays a gym for a one-year membership on January 1st. The gym receives the money immediately. But has it earned 12 months of membership services on January 1st?
Of course not. They've only promised to provide access.
Right. At that point, the company owes something. That's why the original entry records a liability called unearned revenue.
So receiving cash doesn't automatically create revenue.
Exactly. As the company provides the service over time, that liability shrinks and revenue grows.
I like thinking of unearned revenue as an IOU. Every month the company fulfills part of the promise, so the IOU gets smaller.
That's a useful analogy. Just remember, the liability isn't because cash is owed back. It's because the company still owes performance.
That's an important distinction.
And Becker's example follows exactly that pattern. Cash was received first, revenue was recognized later through an adjusting entry because part of the service had finally been earned.
Now, let's flip everything around.
Prepaid expenses.
These feel like the mirror image.
They are. Instead of receiving cash before earning revenue, you're paying cash before receiving future benefits.
Like paying insurance for the next 3 years.
Perfect example. When you first pay, you haven't consumed all that insurance coverage. So initially, it's an asset.
Because the future benefit still exists.
Exactly. As time passes, part of that future benefit disappears. The adjusting entry transfers that portion from the asset into expense.
So here's another analogy. Imagine buying a giant gift card. On day 1, you own value. Every time you use some of it, the remaining balance shrinks.
That works well. The prepaid asset represents unused value. The expense represents the portion you've already consumed.
So I shouldn't ask, did cash leave? I should ask how much benefit is left.
That's the better question, every single time.
I think we've uncovered a pattern already.
What's that?
Deferred revenue asks, how much of the promise have we completed? Prepaid expense asks, how much of the benefit have we already used?
Exactly. Those questions lead you directly to the adjustment.
Now we get to accruals.
These are often the favorite testing area because students mix them up with deferrals.
Let's simplify them.
Accruals happen when the economic activity occurs before the cash.
So the opposite timing.
Exactly.
Let's start with accrued revenue.
Suppose you've already performed services for a customer, but they haven't paid you yet.
Have I earned revenue?
Yes.
Do I have cash?
No.
So something besides cash has to increase.
That's where the receivable comes in. The adjusting entry records the asset because you now have a right to receive payment.
So receivables are basically evidence that value has already been delivered.
Exactly.
Then accrued expenses must be the opposite.
Right. Maybe employees have already worked, interest has accumulated, or utilities have already been consumed. The company owes something even though payment hasn't happened yet.
So expenses can exist before bills arrive.
Absolutely. The adjusting entry records both the expense and the related liability.
Here's the picture forming in my head.
Let's hear it.
Deferrals start with cash first. Accruals start with economic activity first.
That's one of the best summaries you can remember.
Now, let's talk about one area that seems almost like housekeeping.
Error corrections.
The textbook points out that sometimes companies simply recorded something in the wrong account.
Exactly. Maybe insurance was recorded entirely as expense, even though part of it should still be prepaid. Or customer deposits were recorded as revenue, even though services haven't yet been provided.
So, the adjustment isn't because new information appeared.
Correct. It's because the books don't yet reflect accrual accounting properly.
That's another distinction that helps.
Notice what all these adjustments have in common. They're trying to make the financial statements tell the economic story instead of the cash story.
That phrase is worth remembering.
Very much so.
The comprehensive example in the module really drives that home. It isn't just one adjustment. It's several completely different situations happening together.
And that's very realistic. Real companies don't prepare one adjustment. They prepare many.
Let's go through the kinds of adjustments Becca included without getting buried in calculations.
Good idea.
There was prepaid insurance.
Which required recognizing the expired portion as expense.
There was revenue earned, but not yet recorded.
Which required recognizing both revenue and a receivable.
Customer advances.
Which required moving improperly recognized revenue back into unearned revenue because the services hadn't yet been provided.
Unpaid utilities.
Expense plus payable.
Prepaid rent.
Expense increases while the prepaid asset decreases.
Allowance for doubtful accounts.
Recognizing bad debt expense while increasing the allowance account.
Inventory in transit.
Recording inventory that belongs to the company at year-end.
And available for sale securities.
Adjusting them to fair value through the valuation account and unrealized gain.
At first, those examples seem unrelated.
Until you realize every single one asks the same question.
What economic reality exists today that isn't reflected in the books?
Exactly.
I also noticed something interesting. Most of these adjustments don't require complicated math.
That's true. The difficult part usually isn't calculating the adjustment. It's identifying that an adjustment is needed and recognizing which accounts are affected.
So, the exam is often testing recognition before calculation.
Very often.
Let's build one final framework people can carry into exam day.
I like frameworks.
Step 1. Ask yourself whether cash happened before or after the economic activity.
Great start.
If cash came first, I'm probably dealing with a deferral.
Either deferred revenue or a prepaid expense.
If the economic activity came first,
You're probably dealing with an accrual.
then I ask what actually changed because of time passing.
Exactly. Was revenue earned? Was an expense incurred? Did an asset lose future benefit? Did a liability shrink because a promise was fulfilled?
That feels much more manageable than memorizing dozens of journal entries.
That's because you're following the logic instead of chasing the mechanics.
One last thing before we wrap up. What's the biggest trap students fall into?
Letting cash control their thinking.
Instead of letting accrual accounting control it.
Exactly. Financial statements measure performance, not bank balances. Once that idea clicks, adjusting entries become far more intuitive.
So, our mental map looks like this. Accrual accounting sits at the center. The matching principle explains why adjustments exist. Deferrals happen because cash comes first. Accruals happen because economic activity comes first. Error corrections make sure the books actually follow accrual accounting. And Every adjusting entry prepares the financial statements to reflect economic reality at year-end.
That's a perfect summary. Don't memorize isolated journal entries. Start with the timing of the transaction, identify what has actually been earned or incurred by year-end, and let that logic determine the adjustment. If you consistently think that way, adjusting journal entries stop feeling like dozens of unrelated rules and become different applications of one simple accounting principle.